All right, welcome, Austin. How many from out of town? All right, well, welcome to Austin. How about, out of town means Georgetown, right? Okay. All right, yeah. So anyways, my name's Kenn Renner, a real estate broker, real estate investor. And like I said, I've known Ray for over 30 years and married his beautiful sister. So we had first come to Austin, Texas in 1993. And that's our natives are the young ones there. They're native Texans. We're from other states, but Justin is a presidential impersonator. And so if you watch some of his YouTube videos, he's got some viral videos with Obama and George W. Bush, and he speaks internationally as a impersonator. And then Christine on the other side, who's 17 years old, she's a musician, so she's taken after her dad, a co-writer with her music and everything. And then Julia, she's just our caboose at 6 years old, and she's just darn cute. So that's my family. And like I said, I started in real estate in 1983. I bought my first house when I was 19 years old, and it was scared to death. And I was in Anchorage, Alaska. And so, by the way, it's snowing in Anchorage right now. So I saw my friend Scott Carley has a Facebook post that shows it's sort of like 3 feet deep in snow right now. But I got out of there as quick as I could. No, I actually sold that house about 3 or 4 months later and made $17,000 on it. I said, hey, I think I could make a career out of this. So anyways, moved in '86 out to California and met my beautiful wife. And then California's economy was booming. Just amazing economy. And then by around the early 1990s, my father-in-law, George Walter there, said, you ought to check this place out called Austin, Texas. And I said, really? What's in Austin, Texas? I'm thinking oil derricks and tumbleweeds and, and no, he says, you've got to check this place out. And so I started doing some research, and I'm also a predictor of markets, a kind of a amateur economist as it is, because I like to say, I could tell this time I've seen booms and busts. I've seen my dad, who was a real estate attorney, predict booms and busts in different states. And I'm looking at California, I'm saying 1991, 92, there was 8% affordability, similar to where it is now. In other words, 8% of the people could afford a medium price house. And I was like, why would I buy a house here? People are the values are gonna drop. I mean, they're going to drop. Nobody would believe it. But so George said, why don't you come out? Because us as real estate brokers, and we seem to make our money during the exuberant times like now, and we're the last ones to invest just before the market turns, right? Because we finally have the money. So anyways, he said, why don't you go out and take a look? So we came out, flew out to Austin, and that was back in the days of non-qualifying assumptions, no questions asked, and bought 3 houses that first trip for $5,000 a piece, no questions asked, with positive cash flow. I said, I can get behind this. But what was really nice about it was Austin was the city itself. I kind of was like enamored with the city, being a musician and all that. This is kind of, I took this picture back in 2012, I think, and it's changed quite a bit from then. And that's from the top of the Hyatt. But we stayed at the Radisson there, and I was looking out this city, and I'm just going, what is wrong with this picture? And I was like, nothing. And so we made plans to move to Austin, Texas in 1993, got married, and started a new life. And started investing, owned a mortgage company, brought Ray Walter out to work with us, and even his other sister, Mindy, worked for us for a while. But I said, this is the best place in America to live. And according to U.S. News and World Report, it is, right? So then we're going to talk a little bit about what the newspaper articles are saying. What has everybody been looking at? Forbes says that this is the fastest growing city in America. It's now U.S. News and World Report says it's the best place in America to live. We had a crazy amount of job growth, and as an investor, we look for where jobs are going, where jobs are moving. And so we're seeing right now the median income is about $63,000, and we're able to, which means that most people can afford a medium price home that are medium priced in there as far as their income is concerned. $66,000. I guess everybody got a raise. Okay. Forbes also said last year that it was the 7th best place in the United States to invest. So us as investors in this room and investing in Austin and other areas, we've got to make sure that we're what's going to happen. Are we investing in the right place? Is there a bubble? Are we going to be upside down? So I'm showing you the stats that will help you in knowing that in the next 3 years, according to not only Forbes, but an economist, Mark Sprague for Independence Title, the chief economist, said if the prices on the homes under 250 are going to rise up to 27%. So we're not in a bubble. We're not in a bubble by any means. All right? So we're up to 2 million people in this city. When I moved here in 1993, I was driving down the road and they said there was a 2-minute delay on 183, and I thought it was some kind of joke. So we do have some issues with affordability. I service my home, a lot of the people I service are underserviced markets, like first-time home buyers, investors, first-time investors buying their first investment property, kind of underserviced. And our first-time homebuyers and our investors are now being priced kind of out of the market because I tell people with the values going up anywhere from 0.5% to 1% per month, that you're going to be buying a smaller house if you keep waiting, because the house sizes just keep getting smaller and the interest rates are going up. They have already gone up. So with this new administration in place, whether you agree with it or not, I think it's going to be pro-business. So that's my take on it. Average home price right now is $281,000. And as we're going to see on one of the charts here, the neat thing about Austin real estate is it doubles about every 15 to 18 years consistently for the last 40 years. Okay, so I had a lunch with an economist. His name is Mark Sprague. He's the chief economist for the state of Texas for Independence Title. And I had some really great nuggets that I stole from him and to provide to you guys. Economists are kind of funny. He's a great guy, but the good news is that there's 33,000 jobs that were created last year here in the Austin market. We are the #2 job growth in the nation. Super stable economy, and we are in a seller's market, but not a stupid market. And so stupid market is where people are just continuing to bid things. There's certain areas of town that can be a stupid market, but this is where bidding wars on top of bidding wars, and like in certain economies in the West Coast right now is kind of a stupid market. It's over exuberant. We're pretty much in a steady seller's market. The stats show that we've been less than 3 months inventory of homes for the last 3 years, month over month. So for the last 36 months, we've been in 3 months, less than 3 months supply. Our days on the market are about 50 days on the market. And so he said, if your home's on the market for more than 45 days, you priced it too high. So if you don't price your home 95 to 100% of the median of that area that you're at, your house is going to sit. And Texas, this was a cool saying that he said, Texas property is the most undervalued hard asset in the world. Now, I'd like him to expand a little bit more on that, but he was talking about other types of real estate and other worldwide. He was talking about gold, and he was talking about the other types of, he's an economist. I don't know. I'm just took his quote and put it in there. But it's a pretty interesting quote. And he says, we're not in a bubble. We were where California was in the 1950s, except for the traffic. Okay, so expect about 3 to 5% appreciation. We're running a clip about 10% right now. It's a little bit too much of a clip. We don't want to run too far too fast in the values because we'll end up having a correction. And we don't really want to. If you have a nice 5% appreciation rate, that's a stable market that you can bank on. And the homes, like I said, under 250 are gonna. That's the market that is really stressed right now. Very low inventory. I'm just feeling for our graduates, including my son, who's going to graduate from Texas State. I asked the economist. I said, how much does a graduate with a bachelor's degree in business, what are they going to expect income-wise? He said, well, what would you say? Any numbers you think? First-time job, $35,000, $40,000. So my suggestion, if you have parents of kids in school, better clear out that room because they're coming home. No, just kidding. No, actually, funny story. What I told him is I said, Justin, I'm going to help buy you a house in Kyle because a brand new house And they'll build it. By the time it's done, you can move into it, and you can rent the other 2 rooms out and become an investor immediately. And he said, okay. He ran the check down for $500 at D.R. Horton home. Well, about 3 months later, as the house is being built, he says, no, Dad, I want to have the college experience. I want to live in a dorm or at an apartment near the school and get the college experience. I said, sure, fine, that's all right, go ahead. I think it's a good thing. So I ended up buying the house. I actually had George help me with, because I put like 40% down. He covered the difference. I made $13,000 on that house. I asked Justin, I'm going to do it again in another house up in, would you like to join me this time? He says, absolutely, I'll be on that one. So the bottom line is that he could have become an investor and paid for his first year of college just with that one house. So five major U.S. corporations, Mark wouldn't tell me who they are looking at, but these are like Fortune 50 companies, are looking to build headquarters here in Austin. 10,000 companies have moved from California to Austin in the past 7 years. Our biggest asset is the intellectual capital of the city. That's why it's going to continue to grow, and it's going to continue to attract the smart people. 49% have a bachelor's degree. We have the highest educated wait staff in the nation. That's what he said, because they don't want to leave. That's the bottom line. Is that if they can't get it, he said that he was at in the Westin Domain area here having dinner, and he said that the lady there that was serving him was working on her master's. It's like, oh my gosh, Okay, a little Austin summary from 2016. 29,000 homes sold, set a record, up 6.1% from 2015. 2.4 months supply. It's still a seller's market. An equilibrium market is 6 months. 5.5, 6.5. There's 56 active listings, but you know what? Builders will put what they call their ghost inventory, specs that they haven't built yet. They'll put those in there, and you're going to get an extra 1,000 listings in there, even though they're not real, they're not built yet. You can't buy them. So really have a 4,486 active resale listings. Now we have 10,000 realtors in this city. What do you think that those numbers mean? It's tough for those realtors. You think I was talking to my IT guy, and he just moved here from Israel, and he said, gosh, you realtors around here are like fleas on dogs. Because everybody gets into the business and when it's good, and they get out of the business when it's not so good. But I've been in it for 34 years, so I'm not going anywhere. So the shortage will continue for the near future. I think we've got a good another 2 to 3 years left, and who knows? We never know. I can't guarantee that, but I think with the indications and the amount of lots that haven't been developed and the infrastructure that's going in and the jobs that are being created, we've got another 2 or 3 good years, barring any major events. That's why we have the Austin Disaster Relief Network. We got to be prepared for these things. When I'm having a major event, it can. The bird flu, I don't know. People stop buying houses when the bird flu comes around, So just realize that anything can happen, but we're in a good place. Okay, you want to know about the apartment rents? That's a pretty good number. The average apartment rent in Austin's 2016 was $1,189. And according to Axiometrics, it's going to be in 2020, $1,376 for an average apartment in a complex. 14% increase. They're not building enough to keep up with the demand. So a lot of my properties that I sell are that same first-time homebuyer product as a first-time investor product too, as well. Because we'll see that same 14% I'm expecting increase in our rents, and I'm going to enjoy it. Okay, I like these. They're for the charts and graphs, the engineer types in the crowd here. This is what's going to happen according to 2030, and we're already at 2 million people in Austin. So I like the direction of that, up. They got to live somewhere, and in my business, that means they got to buy a house, hopefully, or become one of my tenants. Austin population, look at that, going to 3 million by 2030. That's another 1 million people on the roads. 469% increase since 1960. That's a lot of bicycles, yes. Yeah, or maybe drones, I don't know. I'll have drones by then. Okay, I still like those directions. You know, Austin's kind of got the more fits and starts. Dallas is on fire right now. Their entitlement process is a little bit less, according to the Economist, and so they're able to build properties quicker than they are here in Austin. But Austin's always done well, and since going back into the 90s and into the late 80s, it's done very well. So this is the chart that I really like, because this is something that I can get my mind around. Ray's stuff that he does is way too complicated for me. No, actually it's not. But if I can't put it on a napkin and figure it out, like I I buy a house for $130,000 in '99, it'll be worth $210,000 in 2013. The bottom line is this is the way Austin's market works. It goes up for several years, then levels out. We're talking about median price or less. So it goes up for several years and then levels out, and then goes up several years and levels out. What doesn't happen here in Austin, as it does in other parts of the country, is it doesn't have those 30 and 40% drops like we see in the West Coast or Florida or Arizona, and then the big run up of 100%. I've got another chart that show you that. But so this is pretty comfortable. I know that if I buy a house now, if its history plays it again and repeats itself, it'll be worth double in 15 to 17 years, and I can pretty much count on that. It's a great way to put your kids through college too, right? Buy a $200,000 house now, put it on a 15-year loan, it breaks even all that time, tenant pays the loan off, and in 15 years, you now have a $400,000 house, I hope. Sell that property or refinance, pull it out, and pay the kids' education for all 3 or 4 kids or however many you're going to have. Now this scares me. This is Dow Jones Industrial Average for the past 20 years. This looks like a heart attack monitor. This I don't understand. And that's why I love Ray talking about mutual funds for real estate. That's what we need. We need mutual funds for real estate, because you know what? We have our self-directed IRA folks in the room. There's $4 trillion of our retirement 401k money is stuck in that right there. Only 2% is invested outside. Actually, it's a little less than that. Less than 2% is invested, retirement funds are invested outside of the stock market. That scares me. I don't understand it, how in 2008 it could go down post-Lehman, and then be back up, all the way where it is now at 20,000. And how many people think the stock market's going to have an adjustment? Right? By a show of hands. Okay, the economist said it. Even the guy the financial advisor said it. We were at that meeting the other night, having those free dinners. It's like it's gonna have an adjustment, and so we don't know when. It's just if it's not if, it's when. So I don't understand it. I don't really like to put my money there. I like this. I like this. I can put this on a napkin and I can understand that. And also, we also have the advantage of leverage and depreciation, as all real estate investors know, that we have a lot of tax benefits as well as the build-up appreciation. And then you all are, with this kind of chart, if you're a lender in the room, then you have some security that over time, it's going to be in pretty good shape. Okay, so here's a chart that's made me a lot of money. Because what I've done during these booms and busts and recession times is I've gone to other states during their boom time, like California, and telling them in a room like this, you better get your money out of California because it's going to evaporate as far as your values of your property. In 2005, I went to, and they said, there's no way I would invest in Texas. Our appreciation rate last quarter was 17% in a quarter. I said, it's going to go away. It's going to evaporate. So what we did is we'd have, if you were really smart, you would have bought here in '85, rode the ride up to 1992 in California, 1031 exchanged into Texas, rode it all the way up to around the .com bust. California was in the tank at that time. Then invest here with a 1031 and rode this all the way up. We know some people that have done this. And then in 2006, we know what happens. The values there dropped, and you can see Austin's just chugging along. So my prediction is something with the affordability factor in California. It's going to adjust. So, that being said, is Austin overvalued? Not according to the economist. or a lot of the other sources I look at, $62,000 is all it's needed per year to afford a medium price home here in Austin, which medium price is about $280,000. Nationwide, it's $57,000. We're not that much farther than higher in necessary wages to afford a medium price home. How about New York City, 90 grand? How about San Francisco? You gotta make $157,000 to afford a medium price home in San Francisco. We're between Miami and Portland in our affordability factor. So we still got a lot of room and growth to go, and with all the jobs coming this way, I think we're gonna be in darn good shape, and we aren't in a bubble. Okay, so here's the five phases of a cycle, of a real estate cycle. You have the recovery, you have the expansion, and we're right in the exuberance stage. And so I think the exuberance stage is gonna last a little longer, but then there will be a contraction as the builders overbuild the lots and overbuild the apartments, but that's a long ways off. And then you have recession. So talking to the economist and looking at the charts, we are about halfway, we are about halfway into the exuberance level here. And I think we've got a couple good years, 2-3 years left of value increase. But then this, you never know when, or it's not if, it's when, we will have a slowdown. But hey, keep in mind, the values don't, especially if you stay in the lower end and not get into the luxury market, those values will just level out. What drops in Austin is not values of medium price, it's number of sales. That's what drops. So in 2006, we had 16,000 sales. In 2009, we had like 7,000 sales. But the prices really didn't drop, except in the higher end market. Okay, Dad, how do I get wealthy? Well, just ask George and Faye here. They cut coupons their entire life. No, no. So what happened was my son Justin, who's in Texas State University, actually we had this conversation. Dad, what would you do and I wish I'd take all this advice, but I'm just really, I told him how to get wealthy. It's to make more revenue by bringing more value to the marketplace. Being more valuable to the marketplace, you get paid more, right? Reduce expenses, especially our insatiable uncle, Sam, and property taxes. So that's really important, is that we reduce our expenses. That's kind of easy enough. And then invest the difference, and it's preferably something that you understand. So I don't understand mutual funds and the S&P 500, but I do, I don't understand that. And I know it's a good place for a lot of you guys to invest, but I understand that. So I understand how that works. So going back to his question, I said, really with anything, start early. And do that. So one of the things that I'll be talking about in a couple of weeks, I have a presentation that I'll be talking about how to reduce your property taxes. That's another big issue. So I'll be doing a presentation. And in your packets is all my presentations are free, and it'll be up in Avery Ranch at the D.R. Horton Model Home. So if you're interested in knowing how to protest your property taxes, and also about 1031 tax deferred exchanges and all the other stuff to keep Uncle Sam out of our pocket. And then also I've done very well with my home buying crash courses for just first timers. So if you have any kids we're now working on second generation people buying their houses from us. So in other words, I'm selling houses to the sons and daughters of people who I sold houses many, many years ago. So I'm about education, and it's worked very well. Okay, so hot trends and investment vehicles. Well, private money. I love the idea of a real estate fund, mutual fund. That's just brilliant. Non-bank financing. How many people love going to the bank to get their loans, right? Love filling those tax return stacks and bringing them to, and then, strategic partnerships, and that's what this community here is all about. It's about strategic partners. One of your best investors or your partners or somebody, or best friend could be sitting right next to you in this room. That's what I love about Ray and Kayla putting together a community. I mean, there's some intellectual capital in this room, and I want to learn from it. I made enough mistakes. I'd rather learn from other people's mistakes than my mistakes. So, also self-directed IRAs. We have Rebecca from self-directed IRA from Quest IRA, very highly respected. Where that 2% of the whole, you can actually buy property with your self-directed IRA, or you can invest it in notes, or you can invest it in a fund. So I would visit with Rebecca, and she'll be part of the panel here coming up. And just like we talked about, cause-based alliances. with Daniel's ADRN, with Kathy's Fullness in Christ Ministries. Now, I've started my own cause, which is HOPE, Home Ownership Possible for Everyone. And it's with my classes and anybody that comes to my classes and buys property from me, I donate to both Fullness in Christ Ministries and Habitat for Humanity. Maybe sometime soon, ADRN too. But these are the two charities that I commit a percentage of my gross revenue to, and I'll really appreciate, because I know what they believe in, and I know that the money goes to a great cause. Okay, simple wealth building. I'm not going to go to my soapbox, but buy 10 homes, pay them off in 20, and you'll live pretty well.